social return on investment is a principles-based method for measuring extra financial value relative to resources invested. It can be used by any entity to evaluate impact on stakeholders, identify ways to improve performance, and enhance the performance of investments. A network was formed in 2006 to facilitate the continued evolution of the method. Over 700 globally are members of this network called Social Value UK. The SROI method, as it has been standardized by the Social Value UK, provides a consistent quantitative approach to understanding and managing the impacts of a project, business, organization, fund or policy. It accounts for stakeholders' views of impact, and puts financial proxy values on all those impacts identified by stakeholders which do not typically have market values. The aim is to include the values of people that are often excluded from markets in the same terms as used in markets, that is money, in order to give people a voice in resource allocation decisions. Some SROI users employ a version of the method that does not require that all impacts be assigned a financial proxy. Instead, the numerator includes monetized, quantitative but not monetized, qualitative, and narrative types of information about value development. While the term SROI exists in cost-benefit analysis, a methodology for calculating social return on investment in the context of social enterprise was first documented in 2000 by REDA, a San Francisco-based philanthropic fund that makes long-term grants to organizations that run businesses for social benefit. Since then, the approach has evolved to take into account developments in corporate sustainability reporting as well as development in the field of accounting for social and environmental impact. Interest has been fueled by the increasing recognition of the importance of metrics to manage impacts that are not included in traditional profit and loss accounts, and the need for these metrics to focus on outcomes over outputs. While SROI builds upon the logic of cost-benefit analysis, it is different in that it is explicitly designed to inform the practical decision-making of enterprise managers and investors focused on optimizing the social and environmental impacts. By contrast, cost-benefit analysis is a technique rooted in social science that is most often used by funders outside an organization to determine whether their investment or grant is economically efficient. Although economic efficiency also encompasses social and environmental considerations, in 2002, the Hewlett Foundation's Blended was brought forward by a group of practitioners from the US, Canada, UK and Netherlands who had been implementing SROI analyses together to draft an update to the methodology. A larger group met again in 2006 to do another revision, which was published in 2006 in the book Social Return on Investment, A Guide to SROI. New Economics Foundation in the UK began exploring ways in which SROI could be tested and developed in a UK context, publishing a DIY guide to social return on investment in 2007. The UK government's Office of the Third Sector and the Scottish Government commissioned a project beginning in 2007 that continues to develop guidelines that allow social businesses seeking government grants to account for their impact using a consistent, verifiable method. This resulted in another formal revision to the method, produced by a consortium led by the Social Value UK, published in the 2009 Guide to SROI. Developments in the UK led to agreement between the Social Value International and the Social Value UK on core principles. As of 2009, all but one of the 7 identified principles are now common to the two frameworks. These are: involve stakeholders, understand what changes, value the things that matter, only include what is material, do not overclaim, be transparent, verify the result, The value the things that matter includes the use of financial proxies and monetization of value and is unique to the SROI approach. Since 2008, Social Evaluator from the Netherlands have been working on solutions for impact measurement. In 2013, Social Evaluator built a brand new online software platform for measuring impact, and late 2014, they have launched an inclusive impact measurement platform called investments.A. This enables people to map impact, collect data in an efficient way and analyze the results. The online tool from investments.A is created in such a way that organizations can make better decisions, improve impact and be accountable to stakeholders. More recently, Social Asset Measurements Inc., a Canadian software and consulting company, developed the Social Return Intelligence Suite, which is made up of two interlinked software products, the ARA Impact Reporting and AMP Management Suite and the SABITA Indicator and AMP Financial Proxy Database Service. SABITA was created with funding from the National Research Council of Canada and houses over 500 indicators and financial proxies, which are adjusted for inflation and graded according to the SAM factor, a proprietary algorithm that provides a grading from 0 to 10 based on the quality of the sources used in creating the financial proxy. ARA allows non-SROI practitioners to report within the SROI framework, creating monetized and non-monetized impact reports, as well as outcome and output reports. In 2009-2010, proponents affiliated with the Social Value UK proposed to establish linkages between SROI analysis and IRIS, an initiative to create a common set of terms and definitions for describing the social and environmental performance of an organization. Discussions about how best to do this are ongoing. Some organizations that have used SROI have found it to be a useful tool for organizational learning. Primary purpose. While in financial management the term WAR refers to a single ratio, unlike social earnings ratio, SROI analysis does not refer not to one single ratio but more to a way of reporting on value creation. It bases the assessment of value in part on the perception and experience of stakeholders, finds indicators of what has changed and tells the story of this change and, where possible, uses monetary values for these indicators. It is an emerging management discipline, a skill set for the measurement and communication of non-financial value. Therefore, the approach distinguishes between SROI and SROI analysis. The latter implies a specific process by which the number was calculated, b. context information to enable accurate interpretation of the number itself, and c. additional non-monetized social value and information about the number's substance and context. The principles. There are 7 principles of SROI. These are: 1. Involve stakeholders. Inform what gets measured and how this is measured and valued in an account of social value by involving stakeholders. 2. Understand what changes. Articulate how change is created and evaluate this through evidence gathered, recognizing positive and negative changes as well as those that are intended and unintended. 3. Value what matters. Making decisions about allocating resources between different options needs to recognize the values of stakeholders. The value refers to the relative importance of different outcomes. It is informed by stakeholders' preferences for only include what is material. Determine what information and evidence must be included in the accounts to give a true and fair picture, such that stakeholders can draw reasonable conclusions about impact. 5. Do not overclaim. Only claim the value that activities are responsible for creating. 6. be transparent, demonstrate the basis on which the analysis may be considered accurate and honest, and show that it will be reported to and discussed with stakeholders. 7. Verify the result. Ensure appropriate independent assurance. Monetization principle. The translation of extra financial value into monetary terms is considered an important part of SROI analysis by some practitioners, and problematic when it is made a universal requirement by others. Essentially, the monetization principle assumes that price is a proxy for value. While prices represent exchange value, the market price at which demand equals supply, they do not completely represent all the value to either the seller or the consumer. In other words, they do not capture economic surplus. They also do not include the positive and negative value for others who may be affected by an exchange. Moreover, prices will depend in part on the distribution of income and wealth. Different distributions result in different prices, which result in different proxies for value. Hence, market prices do not always accurately reflect what people value. Proponents of SROI argue that using monetary proxies for social, economic and environmental value offers several practical benefits. It makes it easier to align and integrate performance management systems with financial management systems. It aids communication with internal stakeholders, especially those responsible for finances and resource allocation, and with those who prefer quantitative to qualitative ways of learning. It induces transparency since it precipitates the clarification of which values have been included and which have not been included. It permits sensitivity analysis to show which assumptions are more important and that the result is more affected by changes in some assumptions than others. It helps identify the critical sources of value and streamlines performance management. Despite these benefits, on the con side there is concern that monetization lets the consumer of SROI analysis off the hook by too easily allowing comparison of the end number at the expense of understanding the actual method by which it was arrived at, a comparison which would be an apples to oranges comparison in nearly every case. The SROI methodology has been further adapted for use in planning and prioritization of climate change adaptation and development interventions. For example, the participatory social return on investment framework builds on the economic principles of SROI and CBA and integrates them with the theoretical and methodological foundations of participatory action research, critical systems thinking, and resilience theory and strength-based approaches such as appreciative inquiry and asset-based community development to create a framework for the planning and costing of adaptation to climate change in agricultural systems. PSROI thus represents the convergence of two theoretical tracks: adaptation prioritization, planning and selection, and the economics of adaptation. The main divergence, then, between SROI and PSROI is that while SROI typically analyzes predefined interventions, PSROI involves a participatory intervention prioritization process that is antecedent to SROI-style economic analysis. Potential limitations. Benefits that cannot be monetized. There will be some benefits that are important to stakeholders but which cannot be monetized. An SROI analysis should not be restricted to one number, but seen as a framework for exploring an organization's social impact, in which monetization plays an important but not an exclusive role. Focus on monetization. One of the dangers of SROI is that people may focus on monetization without following the rest of the process, which is crucial to proving and improving. Moreover, an organization must be clear about its mission and values and understand how its activities change the world, not only what it does but also what difference it makes. This clarity informs stakeholder engagement. Therefore, if an organization seeks to monetize its impact without having considered its mission and stakeholders, then it risks choosing inappropriate indicators, and as a result the SROI calculations can be of limited use or even misconstrued. Needs considerable capacity. SROI is time and resource intensive. It is most easily used when an organization is already measuring the direct and longer-term results of its work with people, groups, or the environment. Some outcomes not easily associated with monetary value. Some outcomes and impacts cannot be easily associated with a monetary value. In order to incorporate these benefits into the SROI ratio, proxies for these values would be required. SROI analysis is a developing area, and as SROI evolves, it is possible that methods of monetizing more outcomes will become available and that there will be increasing numbers of people using the same proxies.